The Japanese yen is under severe and sustained pressure. What began as a gradual decline has accelerated into a precipitous slide, with the currency reaching levels not witnessed in decades. This is not a routine market fluctuation. It is a strategic event, and its implications extend far beyond Japan's shores. To be clear, when we speak of a collapse, we are describing a rapid devaluation against major global currencies, particularly the US dollar. The immediate effect is to make Japan's imports, from fuel and food to critical technology, significantly more expensive. But the true consequence is a shift in the behaviour of investors, governments, and rival nations. This is where economics meets geopolitics. A weakened major economy creates a vacuum, and other powers will inevitably move to fill it. China is not merely observing, it is acting. Beijing's warnings are not delivered through military posturing, but through calculated financial signals and quiet, deliberate policy shifts within the global monetary system. Their objective is clear: to reduce dependence on the dollar and directly challenge the dominance of the G7-led financial order. The yen's weakness, therefore, is not an isolated incident. It is a critical front in a larger battle for control over the future of global finance. There is a crucial dynamic here that is often overlooked. A weaker yen may boost Japanese exports, but it imposes a severe burden on Japanese households. As prices rise and wages stagnate, the cost of living squeeze intensifies. This builds profound internal pressure, both political and social. And when such pressure builds within a major economy, it inevitably shapes its foreign policy and strategic decisions. Now, consider China's position. For years, Beijing has been meticulously constructing its own trade networks, payment systems, and currency alliances across Asia, Africa, and Europe. Japan's current vulnerability presents China with a strategic opening, not merely for economic gain, but to fundamentally reshape global capital flows. This is not achieved through public pronouncements, but through a steady, deliberate realignment of financial architecture, largely away from the public eye. In this analysis, we will examine the root causes of the yen's decline and the forces perpetuating it. We will detail China's behind-the-scenes response and explain why it is causing growing concern in Western capitals. Furthermore, we will assess the potential impact on global trade, energy markets, and the value of currencies worldwide. Most significantly, we will connect these events to a broader structural shift, a gradual movement of financial power away from its traditional Western centres. What follows is a clear-eyed assessment of three plausible trajectories for this escalating currency conflict. Each path carries distinct consequences, not only for Japan and China, but for every nation integrated into the global economy. This is a story of high finance, strategic power plays, and real-world economic change. It is still unfolding, and the next moves could redefine the financial balance of power for a generation. For years, Japan has pursued a radically different monetary policy from its peers. While other central banks raised interest rates to combat inflation, the Bank of Japan held its rates at zero, even dipping into negative territory. The strategy was straightforward: to force liquidity into the economy, incentivize spending over saving, and spur corporate investment. However, this long-standing policy has had profound side effects. It has rendered the yen deeply unattractive to international investors. When higher returns are available in the United States or Europe, capital naturally flows out of Japan, driving the currency down further. This policy itself was a response to Japan's decades-long fight against deflation, a legacy of the asset bubble collapse in the early 1990s. For years, prices stagnated or fell, growth slowed, and wages flatlined, creating a vicious cycle of weak demand and low growth. The central bank's solution was to flood the system with cheap money, yet the underlying issues, an ageing population, falling birth rates, a shrinking workforce, remained. Now, Japan faces a new and pernicious problem: inflation. But this is not the healthy kind, driven by robust domestic demand. This is imported inflation, exacerbated by the weak yen. The nation is paying more for foreign energy, food, and raw materials, driving up the cost of living while wages fail to keep pace. The result is mounting pressure on households and small businesses. International observers note a difficult balancing act: A cheap yen benefits major exporters, making cars, electronics, and machinery more competitive, and boosts overseas earnings. Yet it simultaneously increases domestic living costs and financial fragility. If global investor confidence erodes further, the currency could enter a downward spiral, exacerbating import inflation, raising the long-term cost of servicing Japan's substantial public debt and severely limiting its future policy options. The central bank is now caught in a dilemma: protect economic growth or defend the national currency. Each option carries a significant cost. The yen's descent has been so rapid it has shocked veteran analysts, reaching levels once considered unthinkable for a major developed economy. The danger is not just the depth of the fall, but its volatility. Sharp drops, followed by fleeting recoveries, and further declines signal a critical loss of market confidence. Investors no longer trust that a floor has been established, and in the final analysis, the foundation of global finance is confidence itself. Tokyo has not been idle. In recent months, senior government figures have issued stark warnings. They are prepared to intervene directly in the markets should the yen's decline become disorderly. This tactic, known as foreign exchange, intervention involves selling from their vast holdings of foreign reserves, such as US dollars, to buy yen, artificially supporting its value. While Japan has utilized this tool before, it is a measure of last resort. It is a costly endeavor that depletes national reserves, and its effects are often temporary if the fundamental economic drivers remain unchanged. These public statements are a calculated signal, aimed as much at currency speculators as at the markets, a clear attempt to deter those betting against the yen. Concurrently, we are witnessing a significant shift in rhetoric from the Bank of Japan. After years of steadfastly refusing to entertain the notion of raising interest rates, its official language is now evolving. Officials are cautiously signalling that a rate hike is on the table, contingent on persistent price pressures and continued currency weakness. This, however, is a perilous decision. On one hand, higher rates could attract foreign investment and strengthen the yen. On the other, it risks stifling Japan's fragile economic recovery and dramatically increasing borrowing costs for both businesses and a government already saddled with one of the world's largest public debts. The authorities are thus trapped in a policy straitjacket. Act too slowly, and the currency continues its freefall. Act too aggressively, and they risk triggering a recession. The markets are watching this delicate dance with intense scrutiny. Every utterance from a central bank official, every policy hint is dissected in real time, capable of moving the yen in seconds. The result is a currency held hostage by market fear, political pressure, and the profound anxiety of making a critical error at a pivotal moment. Now, turn your attention to Beijing. As the yen weakens, analysts are closely monitoring China's potential response. Currency weakness in one major Asian economy often provides political cover for another. A cheaper yen makes Japanese exports more competitive, and to shield its own industries, Beijing may well allow the yuan to depreciate in tandem, not through a sudden, dramatic devaluation, but via slow, controlled adjustments. This is a quiet, strategic maneuver, executed through monetary tools and policy signals rather than public announcements. This is not a new dynamic. There is a long-established pattern of careful observation and reaction between Beijing and Tokyo on currency matters. The risk here is a classic and dangerous one: competitive devaluation. Once this cycle begins, where each nation deliberately lowers its currency to gain a trade advantage, it becomes incredibly difficult to hold. Each devaluation forces a countermove, creating a destructive spiral. But behind this technical battle over exchange rates lies a far more significant ambition. China's objective extends beyond mere trade competitiveness. For years, it has been meticulously constructing parallel financial structures, expanding its own cross-border payment systems, promoting the use of the yuan in international trade deals, particularly for energy and raw materials, and strengthening financial ties across Asia, the Middle East, and Africa. Critically, these arrangements are designed to reduce reliance on traditional, Western-dominated financial channels. This is a deliberate, long-term strategy to shift the global balance of influence. A weakened yen plays directly into this agenda. Japan, once the undisputed financial leader of Asia, now finds itself on the back foot. Regional partners are beginning to view Beijing as a pillar of stability compared to Tokyo's currency instability. This perception alters negotiations, redirects trade flows, and reshapes financial allegiances. Quietly and without fanfare, the economic balance of power in the region is being recalibrated. When we speak of overturning the G7 system, we are not describing a sudden revolution. We are talking about a gradual, persistent redistribution of global financial power. For decades, the G7 nations have dictated the rules, controlled the institutions, and dominated the flows of international finance. To flip this system is to build viable alternatives that operate outside this traditional sphere. China is using its regional influence and currency as leverage to do exactly that. By signing trade agreements settled in yuan instead of dollars, it diminishes the role of Western financial infrastructure. By encouraging central banks to hold more yuan in their reserves, it slowly elevates its status in the global monetary system. Individually, these steps may seem minor, but collectively, they are constructing a new, parallel layer of financial power. Historically, major powers have sought to avoid such open currency conflicts, with the G7 issuing coordinated statements against competitive devaluation, a lesson learned from the chaotic and destructive currency wars of the 1930s. But in an increasingly fragmented world, these old consensus-based rules are breaking down. Emerging powers are less inclined to follow a playbook they had no hand in writing. China's ambition, therefore, stretches far beyond trade. It is investing heavily in regional financial infrastructure, digital currency experiments, and a network of bilateral swap agreements. These tools enable countries to trade and settle payments without ever touching the traditional Western banking system. Over time, this builds a parallel financial architecture. The ultimate risk is one of fragmentation. Instead of a single, interconnected global financial system, we could be moving towards a world of several competing blocks. If current currency tensions continue to escalate, this will not be a currency war fought with rapid devaluations alone, but a more profound conflict waged through financial influence, strategic alliances, and alternative networks that slowly fracture the global economic order. The most vulnerable point in this entire crisis is not, as one might assume, Japan's major corporations or its banking sector. It is the ordinary household. A depreciated yen directly translates to higher costs for virtually all imported goods. Energy bills soar due to Japan's heavy reliance on foreign fuel. Food prices climb as the cost of imported agricultural products and animal feed rises. Even basic daily essentials are subject to a slow, steady inflation that steadily erodes the purchasing power of families, whose wages have remained stagnant for years. This creates a deep, quiet financial stress. Savings are diminished in value, and monthly budgets are stretched to breaking point. The pressure builds not with a sudden crash, but silently and insidiously, and that is precisely what makes it so dangerous for the broader Japanese economy. The tools available to Tokyo to combat this come with severe trade-offs. Currency intervention, which consumes finite foreign reserves, is a blunt instrument. If deployed too frequently, the government risks having its resolve tested by the markets. Each intervention may provide temporary calm, but it can also increase long-term volatility if traders begin to bet against the strategy, creating a vicious cycle where stability becomes ever more elusive. Similarly, raising interest rates too aggressively could stifle corporate investment and exacerbate the already crushing burden of Japan's monumental public debt. Crucially, the impact of this will not be contained within Japan's borders. Asia is deeply interconnected through trade and financial supply chains. A sliding yen creates immediate winners and losers across the region. Some economies may benefit from a weakened competitor, while others will suffer as their own currencies are pulled into the turbulence. Global investors, sensing systemic risk, may withdraw capital from Asian markets entirely, seeking safer assets and thereby increasing pressure on emerging economies. This kind of contagion spreads far faster than headlines and can destabilize entire markets in a matter of days. On a strategic level, the implications are even more profound. As Japan grapples with its currency, China accrues leverage, not through overt force, but through strategic opportunity. Financial weakness begets diplomatic weakness. Trade negotiations shift in Beijing's favour, regional partners begin to hedge their bets, and the balance of power subtly adjusts. Quietly, Japan is forced onto the defensive, while China advances within a system where economic strength is the ultimate determinant of influence. Looking forward, we see three plausible scenarios. The first is a path of decisive action. Japan intervenes forcefully in the currency market, and the central bank executes a confident interest rate hike. This sends a powerful signal, attracting capital back into yen assets, stabilizing the currency and cooling inflation. However, this stability comes at a heavy price: higher borrowing costs for businesses and government, and a period of slowed economic growth before a new equilibrium is found. The second path is one of chaos. Should Japan delay its response, the yen's slide continues, deepening imported inflation. As energy and food costs rise without corresponding wage growth, public frustration and political pressure mount. Global investors begin to treat Japan not as a safe haven, but as a structural risk, amplifying volatility and encouraging speculators. Regional partners, in turn, would be forced to enact protective measures, spreading financial stress across Asia and diminishing Japan's geopolitical standing. Then there is the third and most sensitive scenario, an emboldened China. Beijing could allow the yuan to weaken in tandem, or more aggressively use financial tools to expand its influence. By offering regional partners trade incentives settled in yuan and forging financial agreements that bypass Western systems, China could steadily shift the balance of power. Japan, already weakened, would find its sphere of influence shrinking, and global markets would witness the hardening of rival financial blocs, forcing investors and nations to choose sides. These paths are not mutually exclusive; they will likely overlap and influence one another. The ultimate direction will be decided in the quiet meeting rooms of central banks and behind closed political doors, far from public view. In the final analysis, the story of the collapsing yen is not merely one of numbers on a screen. It is a story about power, pressure, and geopolitical positioning. Japan is not simply fighting inflation. It is defending its place in a rapidly changing world order. Concurrently, China is testing the limits of its influence within a financial system it did not build. This is why the yen's fall is a global geopolitical signal. For decades, global finance revolved around a few powerful Western centres. That era is now closing. The weak yen, hesitant policy responses, and China's expanding financial reach are all symptoms of a much larger transformation, a fundamental reshaping of the architecture of global money, trade, and influence happening in real time. What happens next hinges on a few critical moves: the decisions of the Bank of Japan, the strategic choices made in Beijing regarding the yuan, and crucially, the response, or lack thereof, from a potentially fragmented G7. These are not minor developments. They will dictate the flow of capital, the distribution of power, and the stability of the global economy for years to come.